In a prolonged period of low interest rates and where some of the biggest names in the FTSE 100 have cut or even scrapped their dividend, enhanced equity income funds are an option for investors looking to earn greater yields on their savings. But to claim those higher dividends, some sacrifices will have to be made. Hello, I'm Mark Dunne, AJ Bell's Head of Research. Welcome to the latest edition of Breaking the Mould, our regular look at the financial markets, where this week I will be looking at a particular type of high-yielding fund. Now, I've got a question for you. What do commodities trader Glencore, miners Anglo American, Rio Tinto, BHP Billiton, Engineer Rolls-Royce and Barclays Bank all have in common? The answer? Well, they've all cut or cancelled their dividends in the past 7 months. Well done to anyone who got that, and if you did, you're probably someone investing for income, perhaps holding some of those stocks in your portfolio which were until recently seen as solid dividend payers. An alternative for investors looking for a higher income generating product is to research enhanced or maximizer equity income funds. Now, they use derivative trading to fund higher dividend payments, a strategy known as writing covered call options. The tactic allows the Insight Equity Income Booster Fund to offer a yield north of 8% as I sit here today, despite the volatility that has hit the FTSE 100 in the past year and the stack of disappointing corporate results so far in 2016. Covered call options sound complex, right? No, not really. This is how they work. A fund manager sells an option giving the purchaser the right, but not an obligation, to buy a stock from the fund at a predetermined strike price on a specific future date. For this, the fund receives a premium regardless of whether or not the option is exercised. Now, if the stock's price does not hit the strike price by the time the contract expires, the fund keeps the premium. It's rather like an insurance policy in that respect. Now, if the strike price is reached, the fund still keeps a premium, but it has to pay the purchaser an additional increase in the stock's value over and above the strike price. A covered call strategy allows funds to boost income from the premiums received, which are then distributed to investors as dividend, while giving up some capital upside when their stocks exceed an agreed future price. So investors must be prepared to hand over their potential capital gains to receive the potentially enhanced yield. This makes such funds attractive to savers wanting income and are not too fussed with capital growth, such as those accessing their pension pots through income drawdown. These funds are not suitable for those with longer term investment needs. They may currently yield more than traditional equity income funds, but this might not be the case in 5 years' time due to traditional versions of these funds having more potential for dividend growth. Insight Equity Income Booster has a 3-year annualised return of 4%, which is lower than the 4.8% generated by the more traditional version of that fund. Now, all investments carry an element of risk, and using derivatives to generate income is no exception. Alongside the option strategy, stock selection is a risk investors need to consider. Now, to generate the premium, these funds could lean towards higher yielding equities, and chasing such investments increases the risk as investors carry. This could be such higher dividends are vulnerable to a cut or being scrapped altogether if the company hits a rough patch and cannot afford to increase or maintain its dividends at the previous year's level. If there is a market rally, the value of these funds won't rise by as much due to management giving up some of the growth for the yield. Now, there are benefits. These funds can perform better in more difficult times for equities, depending, of course, on the skill of the individual manager running the fund. They should be able to get a better price for the options when equities are volatile. If there is a dividend cut in a particular share, the volatility of that share increases, resulting in higher premium prices for the options they sell on behalf of the fund. Remember that there are other products on the market, and the golden rule is always do your homework when deciding where to put your cash to work. Thanks for watching, and I look forward to seeing you next time.